Ever wondered what all those Wall Street bigwigs are talking about? Let's be honest, all that fancy financial talk can feel like a foreign language sometimes. But what if we told you, you could understand this jargon, and all it takes is a little humor and some familiar internet memes? Yes, you heard it right. We are going to break down those intimidating Wall Street terms and make them as easy as scrolling through your favorite meme page. Worry no more because we are about to decode Wall Street jargon using memes. First up, we have bulls and bears. No, we aren't visiting a zoo. Let's dive into the world of Wall Street, where bulls and bears are not just animals but key players in the financial jungle. Now, if you're imagining a bull charging with full force or a bear hibernating in a cave, then you're on the right track. Think of a bull, strong, head held high, always moving forward, charging towards its goal. That's exactly what a bull represents in the financial markets. A bull market is one where prices are expected to rise, optimism is high, and investors are eager to buy. It's like watching a confident bull charging forward, unstoppable. Now picture this. A meme of a bullish person charging forward, unstoppable, with dollar signs in their eyes, ready to invest and make more money. That's the spirit of a bull market. On the flip side, we have the bear. Now imagine a bear, slow, cautious, always retreating and waiting for the right opportunity. That's a bear market for you. It's a market where pessimism rules, prices are expected to fall, and investors are inclined to sell. It's like watching a bear slowly retreating into its cave, waiting for the right moment to come out. Here's a meme for you, a bearish person retreating, waiting, with a cautious look on their face, ready to sell their stocks. That's the essence of a bear market. So, why bulls and bears? Well, it's all about the animal's behaviors. A bull thrusts its horns up into the air, while a bear swipes its paws downward. These actions are metaphors for the movement of a market. If prices are going up, it's a bull market. But if prices are going down, it's a bear market. In summary, bulls and bears are financial jargon used to describe the trends in the stock market. They represent optimism and pessimism, buying and selling, growth and decline. Now you know bulls and bears are not just animals, but also Wall Street's favorite animals. Next on our list is IPO. No, it's not a typo. You might have heard of the term IPO, which stands for Initial Public Offering. It's kind of like a company's debut into the world of Wall Street, much like a celebrity stepping onto the red carpet for the first time. So imagine this, you've got this fantastic new product that you've been working on in your garage. Your friends love it, your family loves it, and you think, hey, maybe other people would love it too. So you decide to take it to the market, but instead of setting up a stall at your local farmer's market, you're taking it to Wall Street. That's an IPO. An IPO is when a company decides to sell its shares to the public for the first time. It's like a grand opening, a coming out party if you will, for companies. But instead of cake and balloons, there are stocks and shares. Before IPO, a company is considered private. The shares are owned by a small group of people, usually the founders, early employees, and a handful of investors. But once a company goes public, anyone who can afford to buy a share can become a part owner of the company. Now, isn't that something? The company hires investment banks to help with the IPO process. They're like the party planners for this grand event. They help determine the initial price of the stock, buy a large number of shares, and then sell them to the public. Why public, you ask? Well, an IPO can help a company raise a lot of money quickly. This money can then be used to fund future growth, pay off debt, or even attract and retain talented employees with stock options. But remember, an IPO is not without risks. While it can lead to a windfall of cash, it also means more regulatory oversight and pressure to deliver profits to shareholders. That's an IPO for you. It's like the grand opening of a company on Wall Street. Ever heard of blue chip stocks? No, they aren't a fancy snack. You're at a poker game and you've got your chips neatly stacked in front of you. Some of them are red, some are white, but the ones you're really excited about are the blue ones. Why? Because in the world of poker, blue chips are often the most valuable. Now let's translate that to the stock market. Blue chip stocks are the big players, the powerhouses, the companies that have stood the test of time. They're the blue chips of the stock market. Think of companies that have been around for ages, companies that are household names. These are the companies that consistently perform well, even when the economy takes a nosedive. Now, imagine the most reliable person you know, the one who always shows up when they say they will, the one you can always count on. That's what a blue chip stock is like in the stock market. It's the dependable friend who's always there, always consistent. Just like your reliable friend isn't always the life of the party, blue chip stocks aren't typically the ones making headlines with sky-high returns. They're not about the get-rich-quick scheme. Instead, they're about steady, reliable growth over the long term. Investing in blue-chip stocks is like choosing to go with the tried and true, rather than betting on the new kid on the block. It's about stability and reliability. It's about knowing that your investment is in good hands. If you're looking for a bit of stability in the roller coaster world of the stock market, look no further than blue-chip stocks. They might not always be the most exciting choice, but they're often the smartest one. So remember, blue-chip stocks are the dependable all-rounders of the stock market. Short selling, it's not about selling shorts. Let's dive right into it, shall we? Short selling, much like our favorite memes, is all about anticipation. But instead of waiting for the punchline, you're waiting for a stock's price to drop. You're watching a football game, and you're so confident that a particular team is going to lose that you're willing to bet on it. That's the essence of short selling. You're betting against a stock, predicting that its price will fall instead of rise. How it works. You borrow shares of a stock from a broker and sell them immediately at their current price. Let's say you sell 100 shares at $10 each, pocketing $1,000. Now, you're waiting for the price to drop. But why would anyone do this, you ask? Isn't investing all about making money when prices go up? Well, not always. Just like in our meme, sometimes you see a downfall coming, and short selling allows you to profit from it. So the price drops, as you predicted, to $5 per share. You buy back the 100 shares for $500, return them to the broker, and voila! You've just made a $500 profit from the stock's decline. But remember, just like betting against a team in a sports match, short selling carries risks. If the stock's price rises instead of falls, you could lose money. And unlike buying a stock, where the most you can lose is what you put in, the potential losses with short selling are theoretically unlimited. Also, it's worth noting that short selling is often criticized for being speculative and potentially harmful to the market. But like any strategy, it has its place and can be used responsibly. So, there you have it. Short selling, it's a bit like being a Wall Street fortune teller, predicting a stock's downfall. And just like our meme, it's all about timing and anticipation. But remember, the stock market isn't a game, it's real money, and risks are involved. So short selling is like betting against a team in a sports match. So, are you ready to walk into Wall Street now? Take a quick jaunt back through the wonderful world of Wall Street terminology we've just navigated. Remember the bulls and bears? Those aren't just zoo animals, folks. They're symbols of whether the market's on an upward trend or taking a bit of a tumble. And when they're fighting it out, it's a tug of war between optimism and pessimism in the marketplace. Then we dove into the world of IPOs, or initial public offerings. That's when companies decide they're ready for the big leagues and invite the public to buy their shares. It's kind of like your favorite indie band finally getting a record deal and seeing their album on store shelves. Next, we took a spin with blue chip stocks. These are the big, reliable companies that are as steady as a rock. Think of them as the superheroes of the stock market. They may not always be flashy, but they're dependable. And who could forget short selling? That's when you bet against a stock, hoping its price will drop. It's a risky move, like pulling the tablecloth out from under a full dinner set. It can pay off big time, or leave you cleaning up a mess. There you have it. A crash course in Wall Street jargon, all thanks to the power of memes.